Lesson number 3, insolvency risk and its management. Here, what you will learn in this lesson, what is insolvency risk and why is it important? Risk and return of futures compared to that of other assets, and potential profits and losses versus real ones. Let's speak of initial margin and leverage. The initial margin is the amount of money needed to open a futures position. And as we shall see later, it is not a cost, but a simple deposit. It's a quantity of money that is asked to deposit at the opening of an operation to cover the risk of the position itself. When the position is closed, the margin is released. In normal market conditions, the required margin is about 10%. This implies that to open a position worth 100,000 euros, only 10,000 is needed. Let's see this again. You are opening a position valued 100,000 euros, but you are putting in the plate only 10,000, a tenth of the counter value of the contract. But beware. It only takes 10,000 to benefit from potential profits over 10 times that amount. Profits and losses must in fact refer to the true value of the contract, not to the money that must be used to maneuver it. A 10% profit is therefore sufficient to double the money invested, but if the underlying moves in the wrong direction, a 10% loss is sufficient to erase the entire capital available. This is, therefore, the main characteristic of futures. They have a high intrinsic leverage. In this case, in the case of the example above, the necessary capital is only 1/10 of the contract value. But there are futures listed in some markets with far greater leverage. Leverage is what makes futures attractive to short-term speculators. The initial margin is a security deposit. Therefore, which is required to cover a risk. It is then integrated and managed according to precise rules aimed at preserving the market from insolvency risk. In order to fully understand this concept, the clearinghouse and its role must be introduced. But first, we need to become familiar with the true nature of the problem. What is the risk-return profile of an investment, the so-called payoff? The payoff is a graph that shows the monetary results of an investment depending on the trend of its price on a certain date. In the derivatives field, the payoff is used to display the potential profit or loss of an operation at the expiry of the contracts in relation to the price trend of the underlying. It serves to get an idea of what could happen following specific events. On the horizontal axis, the prices of the underlying are put at arbitrary intervals. On the vertical, we have the economic result of the investment. So to begin with, consider a simple case. Imagine that you buy 1,000 shares of the stock ABC for 18 euros each. The payoff at any future date is a straight 45 degrees slope that grows from the bottom left to the top right. Profits and losses are directly proportional to the price change. We are at 18. If it gains 1 euro, we gain 1 euro per share. We purchase 1,000, so we gain 1,000 euros. If the price drops 1 euro per share, we lose 1,000 euros. It's a straight line. In the case of futures, the payoff is slightly different, since the price of the futures is not equal to that of the underlying, except in some special cases. For reasons that we will see, it is still linear, exactly like the one on the right, and parallel to the latter, because if the spot price is 18, the futures price is not 18. It could be something higher or something lower, depending on some specific situations. But still, the payoff is a straight line and is parallel to the one shown here. Moving from stocks to futures, to understand how to show the payoff, we must first understand what the fundamental difference between the two instruments is in terms of potential profits and losses. Here we need to focus on a basic concept of investments. As long as a transaction is not closed, profits and losses are only nominal. This happens because the profit and loss are equal to the difference between what has been invested and what is in hand at the time of resale. Just to say, we buy a security for 10, the price rises to 11. If we do not sell it, the profit is purely theoretical. Because in the moment of purchase, if we purchased 1,000 shares, to say, we paid 10,000 euros. In order to get 11,000, we have to sell the stock. Otherwise, that profit of 1,000 euros is merely theoretical. In the same way, even if the price falls down to 5 euros, if we do not sell the shares, the loss is only theoretical. This means that transactions that generate nominal profits or losses have no tangible impact on the investor's capital as long as they are open. Only when they're closed do they translate into real profits or losses. So, if you purchase a stock for 10 and the price drops to 5, if you do not need the money, you can just wait and see if the price bounces back and reaches 10 again. And above all, in trading in stocks, there is no counterparty risk. The value of a position is fully paid at the time of purchase, so the only individual exposed to the risk of falling prices is who holds the stock in his pocket. His counterpart, who sold the shares to him, was paid for the full value of the position, so he doesn't have to worry about what's going on in the market anymore. In other words, if an investor loses money on a stock, it is only his problem and nobody else's. From the point of view of those holding the stock in the portfolio, the maximum possible risk consists in the total loss of the invested capital due to the bankruptcy of the company. Under normal conditions, at the time of the purchase of the security, the entire counter value was paid with own money. If, on the other hand, leverage has been used to purchase those shares, one is indebted to a bank, which has requested guarantees before financing the lever itself. In any case, the amount equal to the equivalent value of the shares purchased was paid. So there is no counterpart on the market exposed to the risk of not being paid for someone else's losses. In an operation in futures instead, as we already know, the matter is different. Those who lose money lose it in favor of a counterpart that collects exactly the same figure. The risk in this case exists for someone. If I lose money that must be cashed by someone else, but that money I have not yet put on the plate, I could even decide not to ever put it. The risk is implicit in the initial margin because it only covers a portion of the potential losses. And this generates the risk of insolvency. A part of the contract could be insolvent with respect to the other. A strong source of risk in the field of futures is therefore given by the leverage, which exposes the market to the possibility that some subject may prove insolvent. This risk materializes when the loss accrued on a position is greater than the capital deposited as an initial guarantee, the initial margin. The problem is that if, for example, the buyer is faced with a loss greater than the initial margin and does not have other money to cover the shortfall, the short seller may not be paid the accrued profits, and vice versa. All this entails the need to implement some risk management system which follows specific policies. There is a fundamental difference between buying a stock and buying a futures written on that stock. To buy 1,000 shares of the stock ABC at 18 euros each, we have to pay 18,000 immediately. And this completely eliminates the risk for those who sell them that the price of the stock could fall significantly from today to tomorrow. We are the only ones who risk it, we as purchaser of that stock. Now, Consider a futures written on ABC, assuming that it involves the control of 1,000 shares, the lot, and that the initial margin is 10%. The value of the investment is still 18,000, but it just takes 1,800 to open it, the initial margin. The risk is therefore only covered up to a 10% and applies to both counterparties, because the buyer may not be paid if the security rises by more than 10%. The short seller may not be paid if the security drops by more than 10%. Now it's time to speak of marking to market, which we will see in the next lesson. For now, thank you for your attention.